Hello, traders. The era of low rates that investors enjoyed during the pandemic is coming to an end. The Fed has launched a monetary policy tightening cycle at a time when the global economy has not fully recovered from the pandemic crisis. Now the majority of central banks are switching to a hawkish stance. Apparently, regulators worldwide will soon follow the general trend of a policy tightening. So now we see the end of the cheap money era and the start of a new one. And let's discuss what happened in the Asian session today. High inflation worldwide is exerting pressure on the stock markets, affecting the sentiments of the US equity market. Started the week on a pessimistic note and closed mixed on Monday. Only the Dow Jones managed to add 0.08%, and the S&P 500 shed 0.4%, and the NASDAQ dropped by 1.2%. Traders got rid of Tesla and Zoom shares, as well as the stocks of cloud computing companies. They were concerned again about the prospects of the global economy, especially after the release of China's economic report yesterday. In April, retail sales and industrial production contracted significantly in China. There was also a sharp drop in the U.S. manufacturing sector. The New York Empire State Manufacturing Index published yesterday fell from the previous indicator of 24.6 to a negative figure of minus 11.6 points. A drastic decline in economic expansion in the world's two largest economies hurt market sentiment. Apart from that, traders are worried about supply chain disruptions, thus may aggravate the situation even more. So the news that Shanghai will gradually begin reopening businesses after more than 6 weeks of a lockdown may slightly ease the tension. Today, Asian equity markets are mostly trading with gains. High inflation and the upcoming rate increase by the Fed, economic slowdown and the geopolitical wars remain the tailwind for the US currency. On a Friday, the US dollar index soared to a 20-year high of 105.10 versus its main rivals. After that, it began to decline gradually. In the Asian session, the index was consolidating in the price corridor of 103.72 and 104.23. At the time of preparing material for this video, it was trading at 103.73, and the government bond yields also slipped into the negative territory. Apparently, speculators are afraid of risks for the US economy because of aggressive rate hikes. In fact, more and more experts tend to believe that the Fed will increase the cash rate by at least 50 basis points at the next two meetings. Such a scenario and the risk aversion are fueling a rally of the US dollar as a safe haven asset. However, top analysts note that the US currency is highly overvalued and that the recession may shake a strong US dollar too. This is why investors are now less certain that the Fed's aggressive tightening will facilitate further growth of the US currency. Meanwhile, traders are waiting for the publication of Japan's Consumer Price Index. The preliminary CPI figure came out with an increase of 1.2% from 1.2%. However, it's crystal clear that the Bank of Japan will not shift to a hawkish stance. On Tuesday, Bank of Japan Deputy Governor also confirmed it. He said that a new spike in energy and commodity prices is not expected in Japan. For this reason, it's important to stick to monetary policy easing. As for the yen, FX strategists reckon that the first bearish phase is coming to an end, so the yen may climb to 125.10 in the long term. During today's Asian trade, the US dollar is holding the upper hand. At the time of preparing material for this video, the US dollar rose to 129.36 against the yen. Moreover, the dollar-yen pair was moving within an upward channel of 128.80 and 129.57. It's now approaching a yearly high of 131.34. The Reserve Bank of Australia raised the key rate in May for the first time in more than 11 years and at the most unfavorable moment for the government before the election. However, what's done is done, and the Reserve Bank of Australia meeting minutes have been released today. The next meeting will be held on June 7 after the federal election. Traders are mulling over options for the size of the rate hike, and the forecast vary from 15 to 40 basis points. There are some other options as well. In any case, the Reserve Bank of Australia needs to adjust monetary policy to combat soaring inflation and eventually return it to the target level. The Aussie has finally rebounded from the multi-year lows. At the time of preparing material, it was consolidating at 0.7034, and the AUD USD pair was trading with a bullish bias, moving between the support level of 0.69 and 67 and the resistance level of 0.7035. And that's all for now. Thanks to you for watching. Please do not hesitate to leave your comments down below and do not miss out on the next video review. See you soon.